Alright, dear, I'm Isaac from PriceWave, and in this tutorial, I want to show you how you can calculate your pips, which is known as your points in percentage. But before that, I would like to tell you more about PriceWave. Now, what we do here at PriceWave is that we make investment easy and affordable, and also we've been able to gain the trust of over 18,000 traders subscribed to our community. And what you get if you join the community is that you get access to free Forex indices, commodities, stocks, and scalping signals. Not only that, you get the opportunity to leverage on our 12 years of trading experience and learn our proven and powerful trading strategies. And lastly, also, we get an advantage of enhancing on our trading knowledge with our free trading analysis that can help you build your trading performance from the beginner level to the advanced level. Now let's pop in into the tutorial and let's learn about pips. Now, what is pips? Pips is the term pips means points in percentage, as I said earlier. Now, the term pip, as used formally in forex trading, maybe you might have heard a lot of traders say, my trade moved 40 pips, my trade moves 50 pips, or I had a hit on sell of minus 20 pips, stop loss, and thereabouts. We want to talk about these pips. Now, this pip, popularly known as the point in percentage, as used formally in forex trading, is a method of describing the change in value between two currencies as they either move up or go down. Now, before we move into the nitty-gritty of pips, we want to know about what forex trading is and how these pips operating relate to the exchange of currency. Now, what is forex trading? Forex trading is the simultaneous buying and selling of currencies in a bid to make profit from these fluctuations, which also means the change in value that occurs over time. When it comes to forex trading, when you want to exchange one currency for another, maybe let's say you want to buy the euro dollar, you want to buy the pounds dollar. Now, if I get to the airport or I get to my bank and I want to exchange the euro for dollar, I'll be buying that dollar and selling my euro. That is forex trading. The moment I exchange my euro for dollar or my pounds for dollar, or I exchange my dollar for euro, I have participated in forex trading. And this simultaneous buying and selling occurs in forex trading itself. And what causes these fluctuations are known as pips. Whenever a price changes, maybe the price of euro to dollar moved from a particular level to another level, there has been a change in what is known as pips. Technically speaking, we'll see there's a change in price. But for this change in price to occur, there must be a slight change in any of its numbers, and those numbers are known as pips. Now, before we go into pips calculation, we would like to know the kinds of currency we are trading in. We don't just go in and just say maybe you want to buy euro and pounds or pounds and euro. If you want to buy euro and pounds, every currency exchange has diversity of values. The amount I will exchange euro to dollar can never be the same amount I will exchange pounds to dollar. The amount I will exchange pounds to dollar can never be the same amount I will use in exchanging my USD to Japanese yen. There must be a slight difference. So this will take us to the three major currency trading pairs we have in Forex, and we have the major currency pairs. As you can see, the major currency pairs are pairs that are actually quoted with the USD, which are the Euro USD, the Pounds USD, the Australian USD, and the New Zealand USD. So these are little of the major currency pairs we have. We have seven major currency pairs, but these are the few for the sake of this tutorial. And secondly, we have the minor or cross currency pair. They are minor or cross currency pair because um, they are paired they are paired they are paired simultaneously with other currency pairs, and we have the euro cross pairs, we have the pounds cross pairs, we have the Japanese cross pairs, and many others also. And also lastly, we have the exotic currency pairs, and we have the USD Mexican, USD South African rand, and we have the USD NOK. So these are the three major currency pairs we have. And mind you, Each currency has a way of calculating its pips. This is what makes them unique. Okay, the major currency pairs are called major because they are paired with the United States dollar. They have the way of they have the standard way of calculating the pips, and also the minor or cross currency pairs, which is known as the euro cross pair, the pound cross pair, and the Japanese cross pair, has a way of calculating pips. What makes them different is that every currency exchange or every currency has a different exchange rate, and this exchange rate actually differs when it comes to fluctuations. You can't buy dollar at the same rate you buy pounds. Or let me say you can't exchange the euro pound the same way you exchange the euro dollar. They don't work the same way. Or I can't exchange the euro USD at the same rate I'm exchanging the dollar and Mexican. So that's just it. And also let's talk about the major currency pairs now. How do we calculate the pips for major currency pairs? How? Now we're looking at the euro dollar. We're looking at the euro dollar as of now. So now let's say the price of euro dollar is at $1 and 6 cents. But what this actually means is that if I want to exchange my euro for dollar, I'll be buying or I'll be buying or selling euro for dollar at the rate of I'll be buying euro at the rate of $1.06, or I'll be selling euro at the rate of $1.06. Why is that? Because it represents the currency price value. And if this is the currency price value, how do I know the peak? When I'm talking about peak, the point in percentage, that means the change, the first unit change. If any currency value must fluctuate, by fluctuation I mean must change in value, there must be a change in the point in percentage. Then how do I know where these changes will come from? Is from the decimal point itself. Remember, we have we have numbers moving from the decimal to the O. So for a currency value to change, there must be a change in the minute value of that currency, and that minute value of the currency is known as the pips. So for it to get to actual pip value, the fourth decimal point is a pip value itself. Now, note that there are exceptions in the valuing of pips, particularly in the case of currency pairs that include cross pairs, as they are often quoted with two decimal places. Now, what I'm in essence saying is that in exception to other currency pairs, you might come across currency pairs that are four decimal places, there are five decimal places, and there are two decimal places. In exception to the major currency pairs, most currency values are in two decimal places. But looking at the major currency pairs, we are faced with four decimal places now. The moment you see that your currency, be it major or whatever you are trading, is four decimal place, just take note that the fourth decimal is your one pip value. The one decimal is your one pip value. So let's go into calculation. Now, when calculating major currency pairs, let's take a look at a chart. Now, we see that the price of Euro USD moved from 1.0693. Remember, I said the fourth digit is your one pip value. The fourth digit is a one pip value. It moved from 0.06. Let's say it moved from 1.0693 to 1.0681. 1.0693 to 1.0681. The price moved again from one, take note of it, from 1.0693 to 1.0681. Now, all we need to do here is to subtract the differences in these two price value to get our pips. Remember, I said that whenever you see a currency price, it's whenever you see a number, let's say we are taking the euro to dollar and we are in essence seeing the present value to be 1.06. This eventually means that I am buying or selling euro to dollar at this currency price. Now, if I decide to buy, or let's say I decide to sell sell Euro USD, and the price moved from 1.0693 to 1.0681. All I need to do is to subtract the differences in these two price value to get our pips. And let's go. The moment I subtract these two values, you notice that I get 12 pips. Remember I said the fourth pip itself is your first value. If the fourth pip is your first unit, then the third pip itself will be your unit in pence. Hope you get it now. The fourth pip itself will be your the fourth decimal point itself will be your first pip in unit, and the third decimal point itself will be your 10th unit in pip value. So let's go into cross currency pairs quickly before we summarize the whole thing and get real with our charts. Looking at the USD JPY, for instance, we will notice that the USD JPY has two units, has two decimal points rather, that's two decimal points. Now, what we need to take note of is that this price we are seeing here is the currency price value itself. Is the currency price value itself. And remember, I said at the trading the major currency pairs, the fourth decimal point is a 1p value. But looking at the USD the second decimal point, because it has two decimal points, the second decimal point rather is our one is our first pip value, is our unit pip, means it represents one pip. Any change you see at the second decimal place is one pip, is one pip. It represents one pip value. Take note, it represents one pip value. Now looking at the chart of USD, let's say I went on a sale and the price moved from 151.10 to 151.00. Now, how many pip value do you think this is? How many pip value do you think this is? So looking at the calculation, as we can see from the chart above, there was a change in the price of USD. Now, what we want to do now is to calculate the change in respect with pip value. All we are saying is price. Now, let me say something for the sake of the video. This will be done in our next tutorial. Now, in order for you to calculate your profit and loss as a trader, you will need this pip value, because whatever pip, whatever change, remember I said pip is the slightest unit that, or the slightest fluctuation in prices, meaning that whenever the rate of any currency value is changing, let's say euro to dollar, it is a product of the pip itself. So if I as a trader want to calculate my profit and loss, I will not use the currency value but the pip value itself. So this is what makes the pip value very, very, very important. So as a trader, it is very best for you to know how to calculate your points in percentage, as this is what you will use in your risk to reward ratio. So now let's say the price of USD moved from 150.10 to 150.00. How many pip value do you think is this? Remember I said the second decimal point represents the one pip value. Now, if there is a change from 150.10 to 150.00, how many pip value is that? That is 10 pips. 10 pips. That is 10 pips. So this is how you calculate your pip value for major pairs and cross currency pairs. Remember I said something, that if you are a trader and you want to know your risk to reward ratio, you will need the calculation of pips in order for you to know how much you are risking to make a trade. When I say risk to reward ratio, when I mean say risk to reward ratio, I mean how much are you willing to risk on a trade to make a certain amount. That means your stop loss or your take profit. Now, for you to know how much you are risking on your capital initially, whether you are risking 2% or 3% or 10%, some even risk 20% or 30% of that initial startup capital for the day. when trading. All you need to do is to know how many pips you are going to risk. The moment you know your pips, your risk pips, or your target pips, you'll be able to know how much you are making and how much you'll be losing. So, in summary, one of the things you need to take note of when calculating your pips is the decimal digit itself. As you can see, we have 1.0640, that is 4 digits, 4 decimal places. Now, if the currency pairs you are trading is in 4 decimal places, you should know that the fourth decimal is your 1 pip unit, your third decimal is your 10th pip unit, your second decimal is your 100th pip unit, and so on. Note that this applies mostly to major currency pairs. Now, when we have something like this 150.10 as in the case of USD we want to know that for any pair found to be in 2 decimal places, doesn't matter the currency, you don't need to bog your mind up with the major pairs, the cross currency pairs, and the exotic pairs. All you need to do is to be able to identify these two differences. Either it is in 4 decimals or it is in 2 decimal places. Just know that when it is in 4 decimal, your fourth decimal place is your 1 pip unit, and when it is in 2 decimal place, your second decimal is your 1 unit, is your 1 pip unit, and your first decimal, that is your 10th unit in pip value. So from Price, we want to say thank you for watching this video and thank you for subscribing. See you in the next tutorial.